So, Jones Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2014. So the first quarter there, the 1st to the 31st of the 3rd, purchases were 4,500 at €6 each, credit sales 1,200 at €10 each, and then cash sales 1,100 at €11 each. The second quarter, we have 2,400 units at €7 each, and then credit sales 2,200 units at €11 each, and cash sales 1,400 at €12 each. The third period, we have purchases of 1,400 units at €6 each, credit sales 1,400 at €10 each, and cash sales 1,600 at €13 each. The fourth period, we have 2,600 purchases at €8 each, credit sales 1,600 at €11 each, and cash sales 1,100 at €13 each. On the 1st of the 1st, 2014, there was an opening stock of 5,200 units at €6 each. So required, number 1, calculate the value of closing stock using the first in, first out Fifo method. Number 2, prepare a trading account for the year ending 31st of 12, 2014. Number 3, outline the implications of an incorrect stock valuation. So, number 1, calculate the value of closing stock using first in, first out method. Okay, so first thing we have to do, work out the purchases in units and in costs. Number 2, work out the credit sales and the cash sales in units and costs, so therefore working out the total sales. Work out the opening stock in units and costs, okay, and then work out the closing stock using the Fifo method. Okay, so the closing stock in units and then the euros using the Fifo method. Okay, so multiplying out the purchases there, you have calculated that all of the purchases were 10,900 units, and when we multiply them by the cost per unit, and you can see how the cost changed at the different times of the year, the total purchases that cost there is €73,000. Then moving on to the sales, doing the credit sales first. The total units sold by credit sales there, 6,400, and the sales revenue generated from those credit sales were €67,800. The cash sales, when we tot them all up there, 5,200 units. Okay, when we multiply them then by the unit cost that we've sold them at, all right, so the selling price per unit there, we get sales revenue of 64,000 when we tot them all up there for the cash sales. So when we're adding them up all together, the total sales in units were 11,600 units, and then the sales revenue, when we add them both up, €131,800. Okay, then the opening stock, we have 5,200 units at €6 each. So when we multiply that out, we get the opening stock figure of 31,200 units. So again, I want you to think about how would we calculate the closing stock in units. So visualize at the start of the year your warehouse, okay? And in that warehouse, you have your opening stock. And in this case, in this question, it was 5,200 units, okay? And during the year then, you're buying all of these number of units here. So you've bought 4, 5, 2, 4, 1, 4, and 2, 6 purchases. But then from your warehouse are going to go all of the ones that you have sold. So they're all going to leave the warehouse then. So you've sold all of these credit sales and all of these cash sales. Okay, so we've worked out all of the totals in those earlier on. So our opening stock was the 5,200 units. Our purchases, when we tot all of these up, is 10,900. And then we minus the sales. So the sales, when we tot all of these up, are 11,600 units. And then that must equal to the closing stock. So what is left in our warehouse at the end of the year then? So that is 4,500 units. Okay, so that is the part 1 done. What we have calculated there is the amount of units. But what we're asked to do is calculate the value of the closing stock using the first in, first out method. So what does that mean? So FIFO means first in, first out. Therefore, the 4,500 units, all right, at €6 each in the first quarter will be the first units that have been sold by the business, meaning older stock here is sold first. Therefore, our closing stock of 4,500 units that we have at the end of the year will be taken from the stock that has just been bought the most recently. Okay, so the 4,500 will include the 2,600 that were bought in the fourth quarter, the 1,400 bought in the third quarter. All right, so that tots up to 400, 4,000 altogether now. And then 500 of the 2,400 bought in the second quarter. So that is all of the 4,500 units there. They're going to be comprised of all that. So let's multiply that out. So 2,608 euro is 20,800. 1,400 at €6 is 8,400. And then lastly, the 500 at €7 is 3,500. So altogether, the value of the stock, all right, €32,700 is the value of the closing stock using the Fifo method. So that is part 1 complete. Okay, part 2. Prepare a trading account for the year ending 31st of the 12th, 2014. All right, so let's go. So the sales, €131,800. Less cost of sales, opening stock, 31,200. Add my purchases, 73,000. Take away my closing stock that I have just calculated there using the Fifo method, 32,700. And then the cost of sales then, 71,500. When you take that away, that gives you a gross profit of €60,300 there. Okay, so that is part 2 complete. Part 3, okay, a couple of theory questions. Outline the implications of an incorrect stock valuation and explain how the concept of prudence applies to the valuation of closing stock. Okay, so we've seen both of these before already in the video, but no harm in reiterating them and reinforcing what we already know. Okay, so outline the implications of an incorrect stock valuation. So incorrect valuation of stock affects the financial statements of 2 years or 2 accounting periods. So it's going to affect the closing stock of 1 accounting period and the opening stock of the next accounting period. So think about your balance sheet and your current assets. You've got your closing stock. So that is going to be your opening stock in your trading profit and loss of your next year or your next accounting period. The figures for cost of sales, gross profit, net profit, and subsequently figures in the balance sheet. In the balance sheet, it will affect the figures for current assets and working capital or net assets. In carrying out ratio analysis, the figure for stock will affect the stock turnover, the percentage markup on cost, gross profit percentage, net profit percentage, and the current ratio. The opinion of the firm in financial circles, its tax liability, its ability to borrow, public opinion, and consequently its share price. The markup on cost in an industry provides a valuable measure for any firm in that industry. A markup that is out of line with the norm is a cause for concern and should lead to immediate investigation to locate the reason and take remedial action. Stock turnover determines the total volume of profit. Therefore, the higher the better. And then the second part to that, explain how the concept of prudence applies to the valuation of closing stock. So the prudence concept states caution should be exercised when preparing financial statements. Therefore, only realised profits should be included in the accounts. However, provision should be made for all expected expenses and losses. The prudence concept ensures that profits are not overstated and losses not understated. If closing stock was overvalued, then profits would be overstated. Therefore, stocks should be valued at the lower of cost or net realisable value. Okay, so this is what a high-low flexible budget question looks like. So it came up as part B of the question in 2015. So let's give it a read. So Boland Limited manufactures a single component for the aviation industry. The following production costs and output levels have been recorded during July, August and September 2014. So this here is July, August and September. So the output levels, the different output levels, 70% in July, 85 in August, 95 in September, and the units are there underneath there. So the units 21,000 at 70%, 25,500 at 85%, and 28,500 at 95%. So the direct materials at 70%, 315, 85%, 382,500, and 95% 427,500. Direct labour, you can see the figures there, production overheads, other overhead costs. Administration, you can see there, it's 35,000 across the board. It doesn't matter what the output is, so therefore this here, administration expenses, are fixed. Okay, we're told then that profit is budgeted to be 20% of sales. So required, separate production overheads and other overheads into fixed and variable elements. Number 2, prepare a flexible budget for 90% activity level using marginal costing principles and show the contribution. Number 3, explain with examples controllable and uncontrollable costs. Okay, so let's get started. So we know already from number 1 that production overheads and other overheads are mixed costs because it's asking us to separate them into fixed and variable elements. So how do we do it? So first of all, we'll look at the production overheads. So we want to separate these into fixed and variable. So if you think about it, the fixed, if these are mixed costs, the fixed are going to stay the same regardless of the output. Okay, so whatever the fixed cost is, it's going to be the same here and here and here. Okay, so the method that we use in order to separate out mixed costs is called the high-low method. Okay, if you think about it, the difference between the high here, which is 95, okay, the high here, and the low here must be variable because the fixed is the same here, and it's the same here, and it's the same here. So any differences between them has to be variable, okay? So because of every stage output, each one of these fixed costs are always going to remain the same, as I've said. So to find the variable cost per unit, this is the high-low method. So high minus low is equal to the difference. So the output here, the high is 28,500, the low is 21,000. That is 7,500 units in the difference. The costs, the high is 140,400 minus the low, which is 106,800, and the difference there is 33,600. So therefore, this must be variable. All right, so 33,600 divided by my number of units must be my variable cost per unit. So €4.48 is your variable cost per unit. So we use the high-low method in order to find out the variable cost per unit. And now we're going to use this figure here, the 448 variable cost per unit, to help us work out what the fixed costs must be. Okay, because we know what the total costs are. Okay, and these total costs include the fixed costs and the variable costs. But now, thanks to the high-low method, we've worked out what our variable cost per unit is, and it's €4.48 per unit. So if we multiply the number of units by €4.48, we're going to work out what the variable costs are across the board. So if you want to pause the video now and just work through that on your calculator as well, you can do that. But you'll see then across the board, our fixed costs are actually the same. So we've got €12,720, €12,720 and €12,720. So you can see it stayed the same regardless of the change in output here. Okay, so that is us having separated the production overheads into fixed and variable elements. So that is the first part done. The next thing that we're asked to do is to split up the other overhead costs into fixed and variable elements. So we're going to do the exact same thing, okay? The exact same thing as we've just done. First step, we'll use the high-low method in order to find out the variable cost per unit. So the high units, so you'll see that this is the exact same as from the previous one. You don't even need to write that out again. Okay, but we'll take the other overheads, high and the low there and find the difference there. So 24,000 euro. So we can find out what the variable cost per unit is by dividing 24,000 by 7,500 units, and that is €3.20 variable cost per unit. Okay, variable cost per unit. There's no need for the second per unit there. Okay, so we can now use the €3.20 variable cost per unit to help us work out how much the fixed costs are. So as we know all of the costs across the board there. We know that the variable costs are €3.20 per unit. So if we multiply the number of units in the output by the variable cost per unit, we will get what the variable costs for that is. Okay, so 25,500 multiplied by €3.20, 81,600, 28,500 multiplied by €3.20, 91,200. When we take all of those away, we should hopefully get the exact same figure going across the board, and we've gotten 4,600 across the board. So that is our fixed costs. So our fixed costs, 4,600 there. Now, the second part of that, prepare a flexible budget for 90% activity level, showing marginal costing principles and show the contribution. Okay, so because we've already looked at the marginal costing statements in the marginal costing topic, we know exactly how to lay out a marginal costing statement showing the contribution. It is our sales less variable costs is equal to contribution less fixed costs is equal to our net profit. Okay, now we have to prepare it for 90% activity. Now we know what 70% activity is, we know what 85% activity is, and we know what 95% activity level is. So we can get 90% by dividing any one of those figures by the percentage beside it and multiplying by 90. So we know our 90% activity level is 27,000 units. Okay, so the materials, these are obviously variable costs. So this was variable, mixed, and fixed. So if we divided each one of these figures by the number of units, we should get the same amount of euros per unit. So direct materials, if you want to stop the video and get your calculator out and divide the figures here by the amount of units, so 382,500 by 25,500, 427,500 by 28,500, you should get €15 per unit across the board. Direct labour, €11 per unit. Production overheads, we worked out in part 1 that the variable cost per unit was €4.48 and that the fixed element was €12,720. With the other overhead costs, we worked out that the variable costs are €3.20 per unit and that the fixed are €4,600. And then the admin, it is 100% fixed cost, so it's going to be 35,000 as well at 90% activity level. Now, very important that we don't forget to read this part of the question. Profit is budgeted to be 20% of sales. So we'll need that later because we're going to want to know what the sales is and to find out the profit. All we have here is what all the costs are. So let's have a look and see what it's going to be like. So under our variable costs, we don't know what the sales are yet, but under the variable costs, we're going to have direct materials. So 27,000 units by €15 per unit, which is 405,000 euro. Then we've got direct labour, so 27,000 units by €11 per unit, which is 297,000 euro. We've got production overheads, which is 27,000 units by €4.48, which we worked out in part 1, and that is 120,960. We've got the fixed part of that. Okay, so the fixed element of that, which was 12,720, which we have also worked out in part 1. Then we have our other overhead costs, so 27,000 by €3.20, which is 86,400. And then we've got the fixed element of that, which is 4,600. Then we're also going to add our admin expenses in there as well, which are 35,000. So they're staying the same, doesn't matter at all what the output is, 35,000, they're fixed. Okay, so now we have all our costs in there, All right, so this just looks like marginal costing statement that we do for our marginal costing when we're doing our break even question. So profit is budgeted to be 20% of sales. Okay, so therefore sales is 100% minus our costs 80%, and then that's equal to profit 20%. If we tot up all of our costs, then we'll know that 909,360 plus 52,320 is equal to 80%. Divide that final figure by 80, multiply it by 100, and we'll get our sales €1,202,100 minus our 909,360. That is equal to our contribution. So we were asked specifically, if you see up in the top of the question, show the contribution. So you probably could get a mark for the word and you could get a mark for the figure here. Now we minus the fixed costs. Sorry, that 35,000 should not be there. And then we'll get our profit, which is 240,420. So that is your flexible budget at 90% activity level, showing the contribution and using marginal costing principles. Forget about that €35 there, that's a mistake.